Hey guys, Taylor with GammaEdge here coming at you with a post-market recap for April 8th, 2025. Sell-off continued today, a little bit of gap up, sold into. Nothing we were looking at today supported that this gap up had any legs to move higher, especially intraday. All of our momentum models were just pointing lower on the session, put dominant environment. So let's get into our pre-market prep, how we came to that. Pre-market prep, we're just going to go to the newsletter we send out before the bell every day. GammaEdge.us, if you want to be put on that distribution list, you can get it for free. As we always do, starting with the market trend model, this was the look coming into the session. If you haven't watched this video before, just a quick breakdown for you what the market trend model is. It's our way of gauging trend and momentum in the market, hence the clever name. It's built off of something called the tick index. If you don't know what that is, you can go to Investopedia, figure it out real quick. Simply put, though, it's a way of measuring real-time buying and selling in the market. Stocks are collectively making an uptick, the ratio moves higher. Stocks are collectively making a downtick, then the metric is going to move lower. Keep in mind that the tick index itself is an intraday metric that resets every day. So what we do is we create something called the cumulative tick, which is this bolded white line here, which is just our way of creating a time series out of the intraday tick, so we can understand not only intraday, but multi-day and multi-week trends of buying and selling transpiring in the market. Yes, you can look at a price chart, but that ultimately doesn't really give you that look under the hood and understanding the magnitude of the buying and selling taking place. And so coming into the session pre-market today, the short-term trend has been lower with the cumulative tick. Looking at the filter tick, which is a metric we created that registers when the tick index has a value of plus or minus 1,000. That is an industry benchmark, generally accepted as being a large buying or selling taking place in the market. So Thursday, we saw a little bit of selling. Friday, we had selling all day. Yesterday, Monday, we had net selling. And so, right, from a short-term trading point of view, swing trading point of view, like the trend is decisively lower. Nothing here is saying being bullish. If we want to be bullish, we need to see the cumulative tick start to turn back up and trend higher, similar to a signature like this. It's need to see follow through. We didn't see follow through last week. It subsequently rolled over, obviously, right? But these are the patterns and the signatures that we look for. So after understanding the market trend model, then we go and we look at the SPX options complex. Why the SPX options complex? One, it's the most liquid and deep market in terms of option activity. B, options market is inherently forward-looking. So when we have this much options activity taking place in the SPX market and it's forward-looking, it makes sense that we evaluate this to understand how speculators are positioned. Not only that, there's two components to SPX. There's SPXA and there's SPXP. SPXA, think of as your cruise ship. The reason for that is because it is much larger than the SPXP, and the capital that transacts here is longer term in nature. So you can think institutions, as this is where your monthly and your quarterly expirations reside. So having said that, we are in a put-dominated environment. That's been no secret. We've been in a put-dominated environment for a long while now. Yes, we were significantly gapping higher than yesterday's close. However, keep in mind, the environment is extremely pessimistic, extremely put-dominated, so that really doesn't change the SPXA complex just because we gap up 100 points or whatever it was. And so you can see what a call-dominated environment looks like. Here's a historical example just so you can understand the contrast between what this looks like, which is call-dominated, green everywhere. This is a bullish foundation where we expect continued price appreciation. And now flipping back to the current structure, obviously the difference in structure should be very apparent. Now moving on to SPXP. Remember SPXP, that is your cigarette boat. The reason for that is because this is where your shorter term speculators tend to transact and the contracts turn over much quicker relative to the SPXA. SPXP, this is where your 0DT, your dailies, and your weekly expirations reside. And keep in mind 40 to 60, 70% of all SPX options activity takes place in the 0DT contract. So that is why we have a very big focus of ours is on the 0DT markets as well, which I'll get to in a second. But again, you can see here the short-term SPXP, this is put-dominated environment as well. Really not a lot else to say here. So again, stepping back, market trend model, decisively trending lower, bearish. SPXA put-dominated, SPXP put-dominated. So if you didn't look at anything else, from a swing trading point of view, the environment is quite crappy for that right now. So, right, our thought process coming into the day was, okay, we had a gap up, sweet, but it's still in the context of a terrible environment right now. So we need to see a lot of convincing evidence, both intraday with the market trend model moving higher and our intraday volume analysis that we'll get to later, suggesting that there's continued call speculation higher. Newsflash, there was not. We subsequently melted down, but we will get to that. Another sentiment indicator I want to run you through real quick is something that we call the GEX ratio. The GEX ratio takes all expirations into account. We look at total call gamma relative to total put gamma in the SPX complex. You can think of this ratio as similar to the put call ratio. However, we think this is superior. The reason for that is because there is a time component inherently baked in the calculation because of the use of gamma, which remember is most sensitive at the money and nearest to expiration. So this calculation inherently kind of self-limits to those more near-term expirations where gamma is larger. As an example, you put on 1 million put contracts 2 years out, that's going to skyrocket the put call ratio, right? But that's not going to do much to the gamma ratio, to the GEX ratio, because that position is so far out, it's not really impacting near-term structure. With us as traders, that's what we care about most. And so looking at the ratio itself, yes, I realize it was very choppy, but looking at the time series back, to November, since last November, price action itself was very choppy. And then right now, the current conditions where we are today, we've been in a downtrend and now we're just bumping along towards the bottom. So again, there's been little to no evidence that call speculators have, meaningfully come back into the complex. And we're also below 1, which indicates that puts are greater in the complex than calls too. So I think we've hammered home pretty good why, the environment is what we said it is and how we go about looking at that. Now moving on to the 0DT complex real quick. We're gapping up right to 5,200, about 100 points away from where we settled yesterday. Keep in mind, this gap higher is far from the center of the SPX structure, which is centered around right where we closed yesterday and where those folks went home in terms of how they were positioned coming into the day. So when you hear us talk about our transition zones and everything like that, those aren't super relevant today because we are gapping so far away from them. This is where we tend to get more disorderly market action relative to orderly market action, which is more within our transition zones. So again, what we were saying this morning is this where we need to see either the market trend model and our intraday volume analysis confirm this move higher, or we're going to see it roll over because there is no call speculation continuing the move higher. And then just keep in mind, there's an expected move of 251 points today. So again, we know the markets have been very volatile lately. So we really wanted to wait, let the market transact the first 30, 45 minutes and kind of see if we could get some clues from there. So right, we gapped up to 5,200. We failed to really make a push above 5,250, which we couldn't even get above the high of the Friday gap lower. And then right, we just proceeded to melt down the entire rest of the day. So again, back to that 250 point range, like that came true. We gapped up to 5,250, and then we melted down to 5,000. You're probably thinking, okay, cool, I don't need GammaEdge to tell me the price melted down. I have a price chart myself. I could see that. However, there were a few intraday tools that we used that helped confirm this move lower throughout the session. And right, we weren't sitting there hoping and praying for a bounce or for a continuation higher because it simply was not coming based off of the intraday activity that we saw. That first starts with the market trend model again, right? We've already recapped what the market trend model is. So looking at how it acted today, here is the gap up and the open. And really, we saw no impulse higher. We also saw 0 filter tick buying. So that was a sketchy clue right there that, if this market was going to go higher, especially after the oversold conditions, we would have likely seen both of those, which is traditionally what we see given an environment in a move like that. So frankly, it was easy for us, and it should have been easy not to get sucked in that gap higher and perceived gap and go that never manifested, right? And then throughout the rest of the session, like just a trend lower all day of the market trend model, just a resumption of what we had. And then we also saw a linear down day in terms of filter tick selling too. So that there was key as well. I was telling us, hey, no bounce is coming because there is heavy selling all throughout the session. Additionally, we'll spend the rest of the time going over this. This is our vol M chart, which is just our way of visualizing our intraday volume analysis. And in English, what that means is Throughout the session, we analyze SPX 0DT volume, both call volume and put volume. What we do is to make it useful, is every 5 minutes, we aggregate the call and the put volume separately. We analyze that distribution of volume to find the center point of that distribution, which is called a centroid. Then what we do is we plot those centroid values every 5 minutes on the chart. We connect the dots to create lines for you. The reason that we do that is because at any point from the market to whatever point in time we are at in the market, we can understand the behavior of the call and put speculators. So as an example, say it's 11:30. Here from the call side, we see that centroid, which again, remember is the center of that distribution every 5 minutes, that is not progressing higher. You would think that if we are, going to see, a sustained rally higher, what we do see time and time again is the call centroid is consistently moving higher, right? Because again, it's our opinion markets are driven by out of the money call and put speculation. Price does not go where transactions are not occurring. And so you can see that there were 0 call transactions taking place above spot price, which frankly, I can't remember how many times I've seen this kind of character right here before. Generally, it looks like this, where the speculation is always happening above spot price. But anyways, that's not the point. The point is that speculation was not progressing higher. We can see all day speculation was just trending lower and lower and lower. And then same thing with the put side. Granted, put side was quite erratic today, but the general trend was lower. And then just note the gap between the call and the put side. I mean, this was like 200 points wide all day. We generally don't see it that wide, especially into the close. We generally see those lines of best fit, 20 points wide maybe, and they're like 200 points wide. And again, I skipped over lines of best fit. The lines of best fit, what those are is, say it's 11:30. We understand what the behavior of these call centroids are. We draw a linear regression through them, which is what we call the line of best fit, and we can project out the likely price of path, assuming speculators behave in a manner that they have been. Now, if that forward manner changes, then that line of best fit is going to change, and the rate of change of that. So either call speculators start to speculate higher throughout the session, that's going to ramp the line of best fit, or they're going to go lower. That's obviously going to change the rate of trend to be even more severe lower. So just so you can see just how this is actually actionable, right? Because we were just looking at the end of the day print. Again, we print this chart automatically every 5 minutes because we calculate that centroid value every 5 minutes. So here's what it looked like at roughly 2 o'clock. Again, we can see the behavior of the call centroids has been lower all day. Hence, the line of best fit also is moving lower on the session. And then the put centroid side has been quite erratic. So that is moving sideways to lower as well. So at this point in time, right, we have the market trend model, which was melting lower. We have call speculation that's melting lower. So we should not be expecting any kind of material ramp higher, back to high of day or something like that at this point in time. So obviously, the intraday range was massive today. And, zooming in on 5-minute candles or whatever you look at on your chart, those 5-minute candles were printing between 25 and 50 points at a time. So that's just huge range. And so, right, the way this is useful is we kind of have our directional bias set. So, if you're a credit spread trader, as an example, understanding where we're likely not going, right? That's the key for that strategy. So these centroids, lines of best fits, are very useful for that. Selling above and below the centroids makes a lot of sense, or you're able to at least take away one side of the market, right? Using a golf analogy for, off the tee box, if you're able to draw the ball consistently, then you're taking right out, which is very useful. How to play that's the same thought process with our volume and the use of the centroids, right? And we settled right at 5,000 today, which at 2 o'clock, if you would have known that using this chart, that was pretty good, pretty useful. Not bad when we had such volatility out there. So hopefully that makes sense. Hopefully the use of the centroid and the vol M chart makes sense. And right, the market trend model, understanding SPX structure, and then the volume analysis, like that's all stuff that you can implement tomorrow if you wanted to. Not saying you have to, right? This is just how we view the market, but we find it very helpful, especially during these volatile times. And not only during the intraday volatile times, but stepping back and looking at the overall structure and seeing the structure either further deteriorate or when it starts to improve. Right, because as part of our market term framework that we've reviewed the last couple of videos, so you can go back and look at our post-market updates where we go through that in more detail, right? It starts with the market trend model trending higher. Then we start to see thawing out of the SPX complex, generally SPXP, remember, because it's shorter term. Then SPXA will. And by thawing out, I mean that either puts are starting to be closed and or call speculation is starting to come back into the market, none of which factors are present today. So with that, I hope this video was helpful. I hope our other videos have been helpful with you kind of navigating the market, understanding from a structural point of view where we're at. Obviously, unless you're in the community, you don't have access to the intraday tools or the market trend model. But nonetheless, you at least can get a post-market recap, and the market trend model and the structure doesn't change on a dime, so you can still understand, going into tomorrow what the structure is like tonight. So with that, wish you all the best of luck, and we'll talk to you tomorrow night. All right, bye.